think this thing automatically goes live once it's ready, so we'll just wait. Live in 13 seconds. All right, well, thank you everybody for attending our webinar today. Today we are going to talk about some essential tax credits for our savvy hotel owners. Just making sure that everyone's on the page with what you can do in order to help save money. Again, specifically hotel owners, but a lot of what we're talking about will work for other people as well. So with that, I'll start the presentation here. We'll introduce ourselves in a second, but I always like to start with explaining to everybody what we are going to do. I think that helps. So first thing we want to do is we're going to do a little bit of introduction to myself and Seth. So I'm Leyton, Seth is with IncentiFind. We're going to talk a little bit about some of the tax incentives and then a little bit about property tax, just to give you a frame of reference on why some of that might be important. And then a little bit about how IncentiFind can help specifically for hotel owners. So with that, I will introduce myself. Hello, everybody. My name is Mark Bacon. I am a professional engineer, and I'm the practice lead for our commercial real estate or energy efficiency service line at Leyton. If you're not familiar with Leyton, we are an international tax consultancy firm. We're in 16 countries, been in business 25 years. So we do this type of work all over the world. So specifically, some of these energy studies we're talking about, as an engineer, I've done about 10,000 of these studies. So fairly familiar with energy efficiency for hotels, been in hotels all around the country. So I'm looking forward to chatting with you a little bit about energy efficiency. And Seth, over to you.
Hey everyone, my name is Seth Thompson. I'm the commercial sector lead for IncentiFind. IncentiFind, we built the national database of green building incentives, and we streamline the process of helping property owners identify and capture green building incentives on their properties. We've done a lot of work with hotels over the last several years, so excited to dive in and show you how we can help.
Perfect. All right. Well, with that, I'm a big fan of telling you what I'm going to tell you, then telling you, and then repeating it. So people tend to appreciate information if you hear it 3 times. So I'm going to go to kind of a more catch-all slide to give you an idea of what type of incentives will be available. Now, these are all tax incentives, and I realize this slide is really wordy, but also I realize this slide is most of what you need to know in terms of tax incentives if you're a hotel owner. So I want to start with, I'm going to go out of order here, but I want to start with the one that I hope you are familiar with if you're a tax or a hotel owner. One of the most important tax strategies if you own a hotel is things around accelerated depreciation. Now, I'm hoping you've heard the term cost segregation. So bear with me if you have. I'm going to explain it here for a few minutes, and then I've got some slides with a little more background later. But the essential idea behind cost segregation is if you are in your hotel right now and you look around, you will depreciate your building over 39 years. That's standard way we depreciate buildings over time. Now, if you look at the components of that building, do you really think your carpet is going to last 39 years? Of course not. So what the IRS allows you to do is accelerate some of that depreciation through a cost segregation study, which basically allows you to depreciate it quicker on your books. Carpets will go into like a 5-year property. We know they're only going to last 5 years instead of 39. So what it really allows you to do is take the costs of that and basically depreciate it or deduct it faster. So cost segregation is something that you probably should be doing. Hopefully you are. What I do find though is even people who are doing cost segregation may not know about some of these other incentives. So specifically the one that's likely to apply to a lot of hotel owners, and we do this on a lot of hotels, is the 179D tax deduction. The way I like to think about it is cost segregation is the cake. It's 30 to 60%, 20, 30% of the cost to put the building in service. Huge amount of depreciation that you can accelerate. 179D is icing on top of that cake. So if you are already accelerating depreciation from something like cost segregation, you should layer on top 179D. Now, you may come to me and say, well, I'm not building an energy efficient building. I'll tell you, you probably are, and I can explain why in more detail. But there's a very good chance if you're building a hotel to code, you get a very good chance of qualifying for energy efficiency tax deductions as well. Now, cost segregation, as I mentioned, 15 to 30% of the cost to build the building. 179D is on a per square foot basis, and right now it's worth up to $5.81 a square foot. So if you look at the square footage of your building, multiply it by $5.81, that's the potential tax deduction you're taking. So basic idea is if you're taking cost seg, you're already in a position to take accelerated depreciation. You should probably be doing 179D as well. Now, the residential side of that, now a lot of you probably don't own separate residential areas, but if for whatever reason you do, if you have an apartment building on the side or something like that, you should be looking at 45L tax credits. Very similar thing. Big difference between 179D and 45L is 179D is for commercial or large residential buildings. 45L is for smaller residential buildings, basically. So it's on a per dwelling unit or per dwelling basis. So the number of doors or number of dwelling units, if you want to look at it that way, it's up to $5,000 per door. It's a pretty significant benefit if you have, a 300 unit complex. You can do the math on that one pretty quick, but it's a very useful tax credit if you're able to take it. But again, hotels qualify as commercial property, so they're likely to be 179D. The final one we can talk about a little more is one that you probably have heard of, even if you haven't heard of the term Section 48E or Section 48. Those are clean energy credits or investment tax credits, ITC, they're also known as. So investment tax credit, ITC, is basically a credit for the installation of certain energy property. So if you have heard of it, probably because at some point someone quoted you on putting solar on your roof and they said something about a 30% tax credit. So if you've heard somebody pitch you on a 30% solar tax credit, that's what it is. It's Section 48E. Now, it's not just for solar. It's also for battery storage, wind, geothermal is a really big one in Section 48. So if you're using any of these technologies, solar being a really common one, you probably should be looking at taking Section 48E tax credits. Hopefully your CPA is able to help you do that. If not, Leyton can definitely help you out. So that's kind of the high level, just as I said before, tell you what I'm going to tell you and then go through a little more detail. So with that in mind, cost segregation, as I mentioned before, leading with that because I'm hoping it's the one you're most familiar with. It is basically tax planning purposes. You can use it if you've built a building. You can also use it if you've renovated a building or acquired buildings. So it's very multifunctional tax planning strategy. And as I said, the benefit on it is quite large. So if you're in any of these scenarios where you've recently built a building, you're renovating it, you're basically adding to it in any way. If you're adding basis to the building, you want to consider a cost segregation study. Now, what does that actually look like? So as I mentioned, a commercial building depreciates over 39 years. Residential is actually 27 and a half. Now, the best way to think about a cost segregation study, I heard this analogy a while ago and I love it, so I'll use it. What can you do cost segregation on? What assets within a building are you able to accelerate depreciation on? Take the building, flip it upside down and shake it. Anything that falls off, you can do cost segregation on. So we're talking flooring, we're talking cabinets, we're talking anything like that, equipment, those can all go into a cost segregation study. What you can't do a cost segregation study on is structural elements. So things like insulation, things like some of your HVAC equipment, you can't accelerate. Fortunately, you can accelerate those with 179D, which is another reason why they pair together so well, is they don't really conflict with each other. But the basic idea is you reclassify them into different asset lives, which are things around personal property, land improvements, and then the actual building itself, which is why I said the structural elements are part of the actual building itself. And as we mentioned on the first side, you're really looking at 15 to 30% of it you can take in the form of a tax deduction. So extremely powerful. Again, I hope you've heard of this. If you haven't, please give me a call later. There are reasons why you wouldn't do cost segregation, primarily tax positioning reasons. And I can kind of go through a little bit of that in the next slide here. But basically, what you want to look for when you're looking to do a cost segregation study is you want it to be a long-term hold. If you're planning on selling it, you can't just go and take a whole lot of depreciation on the building and then sell it. The IRS doesn't like that. So there's going to be something called a recapture penalty. So you can't just go and take, say you build like a $90 million building, you can't go take $30 million of tax deductions and sell it the next year without paying a penalty. So you want to have long hold. The other thing with cost segregation is it's really important that you understand the ownership structure, like how the flow through works, how many owners. So if we're not going to do a cost segregation study for some clients, sometimes it's because they have 15 owners, and then you have dilution of benefit. So there's a few factors you want to consider on whether or not you're going to do cost segregation study. Coincidentally, all of those factors really matter for 179D, 45L, and investment tax credits as well. So I always tell people, if you can do cost seg, do the other ones. If you can't do cost seg, let's investigate what the financial reasons are. There's not a lot of technical reasons why you wouldn't. But one of the technical reasons is you probably should be looking at a build of more than $1 million, which realistically, almost all builds are more than $1 million. If you get below that, you're likely into a building that's too small to potentially justify doing a cost segregation study. And you want to look at, you've done a bunch of different things. If you're only doing, I don't know, one small thing, like you've acquired a hotel and all you're doing is switching out to LEDs, then you probably want to consider whether or not a cost segregation study makes sense. I mean, you probably aren't going to do $1 million of LEDs to begin with, but just something to consider. And with that in mind, quick case study, just to give you an idea of what this actually looks like. So like as mentioned before, we do a lot of hotels. So this was a hotel, privately owned. Fortunately, ownership structure was fairly simplistic. It's a 54,000 square foot hotel they built in 2022. It cost them $90 million to build it. And then we did a cost segregation study the next year. Basically, it's a new modern building, so it's pretty easy to do. We had all the building plans, so it makes it a little easier. You do a site inspection with cost segregation just to make sure we're capturing everything that should be accelerated. I will say there's not necessarily a requirement to do a site inspection because we do get asked that fairly often. But if you don't, it's highly recommended by the IRS. And if you don't, you're definitely going to be missing out on accelerated depreciation. So it's really important to have those site photos to be able to figure out exactly what we can accelerate. But the net result of this is they were able to, of their $90 million build, they were able to accelerate depreciation on about $28 million of assets within that building. So that generates significant tax savings really early in the life cycle of a building, which most of you know is very, very important. So you acquire a building, you want to accelerate depreciation because you want that time value of money working on your behalf. You want to be able to use that money to reinvest in buying another building or improving another building or whatever else it might be. I will say, don't do a cost segregation and then not use the money. Otherwise, there's not really much reason to do it. Make sure you actually use the money for something. So if you get a plan and you need some more income, cost segregation is an amazing way to do it. And with that, I'm going to shift gears here a little bit to 179D. As promised, I wanted to give you a little bit more clarification. The reason why 179D pairs so well with cost segregation is because you can see kind of in green the pieces that 179D touches. So it touches the interior lighting, the building envelope, and the HVAC and hot water equipment. It's really important because, as I said before, cost segregation study, you take a building, turn it upside down and shake it. The things that aren't going to fall out are your interior lighting, your building envelope, and your HVAC systems generally. You can then accelerate the depreciation on those assets through a cost or a 179D study. So you're kind of able to really maximize the amount of first year tax deductions you can take by combining these two technologies or these two incentives. Now, obviously, hotels are a great example of something you should do 179D on, but any of you out there, if on the side you've got a warehouse, I love doing 179D on warehouses. They're big open spaces. We have to do an energy model for them. It's a lot easier to do an energy model if I don't have to draw a whole lot of walls. So if you do own warehouse, great candidate for 179D. Offices, fairly simple. Schools. When we get into hospitals and correctional facilities, military bases, they get a little more complicated when you go to do the energy model, just because hospitals, as you can imagine, handle a little more sensitive components, so they need to be pretty careful on how their HVAC is designed. But the other kicker here, it's really important, is we say you're comparing to an ASHRAE standard 90.1. Now, what does that mean to you? We're currently using the ASHRAE standard 90.1 from 2007. So that means if we're going to say your building is energy efficient, I am comparing your building to basically a code building from 2007. So if you're building to a modern code or you're renovating up to modern code, you're going to compare very well against an ASHRAE 90.1 2007 energy standard. So obviously it's not guaranteed. There's a lot of things that go into this, but we build an energy model. It's required by the IRS tax code. And we build it to Department of Energy standards using DOE approved software. And we compare it to an ASHRAE 90.1 building. And if you meet certain percentages of savings, you qualify for 179D tax deductions. It's very rare we run into buildings that don't qualify at all. There's usually some money on the table somewhere, and we'll find it for you. So again, if you're doing cost seg, layer on 179D because you're already talking about the same components. And just to illustrate what that actually looks like, a quick case study. Hotel, as I said, we do a lot of hotels. This is about a 70,000 square foot building. Placed in service in, they started building it in 20, finished in 23. In 2023, the 179D tax deduction was worth $5.36 a square foot. So likely they did cost segregation in the study. We didn't do it in this case, but they would have layered on, in addition to their cost segregation, they would have layered on an additional $370,000 in tax deductions that they were able to take. So really, really beneficial. Just kind of building the way they were building. You don't have to make any changes in what you were doing generally to take 179D. It can be advantageous to consider it early in the life cycle, but generally speaking, you're going to do pretty well on 179D. All right, change gears again here. And I will say, in case anyone's interested, I did an entire 2-hour webinar just on 179D. So I'm giving you the very, very high level here, but there's so much information in there. Could literally talk about it for 2 hours. So if you do have additional questions, please let me know. I am happy to nerd out on 179D whenever it becomes necessary. So 45L. Couple interesting things here. I'm not going to spend a lot of time on it because it likely doesn't apply to most of you unless you happen to own an apartment building or a set of single family homes on the side. So 45L is for multifamily and single family homes. Placed in service up through 2022, it was worth $2,000 per unit. We get into 2023. The big change from a legislative point of view in 2023 was the Inflation Reduction Act was launched. What the Inflation Reduction Act did is it drastically increased the value in a lot of these tax incentives like 179D and 45L. That's why 179D is worth $5.81 a square foot right now, is because the IRA increased its value. But what the IRA did for 45L is it increased it from $2,000 a unit all the way up to potentially $5,000 per dwelling unit. But the big caveat is you now have to meet Energy Star construction or zero energy ready homes. If you're meeting Energy Star, you get $2,500 a unit. If you're meeting zero energy ready homes, you get $5,000 a unit. So those are really prescriptive requirements. So if for whatever reason you're thinking, I've got an apartment building, I'm building it, you want to think about doing Energy Star and having an Energy Star contractor pretty early. There's not a good way of doing it retroactively. So if you've already placed a building in service, it's going to be pretty hard to qualify for Energy Star unless you already were. But there's a lot of things in here with buildings that qualify. As I mentioned, really we're looking at multifamily. So think affordable housing, apartment buildings, senior living. I'm not going to go through the whole list here, but single family homes are often neglected on 45L. People forget if I'm doing like a tract home development of 100 homes, probably be doing 45L on that. So just a frame of reference for you on what this can be used. And I'll go through a case study, and I see we had a fun question come through the chat that I knew was going to be asked at some point here, but I'll do the case study first, and then we can talk a little bit about the joys of the current politics and the situation that's going on with the Inflation Reduction Act. But 45L, this particular client, 64 units, single family home, so 64 homes. In this case, this was from 2022, so it's using the legacy $2,000 per unit. So they get a $128,000 tax credit just for the single family home development they were building. So again, very valuable incentive if you happen to be able to leverage it. So I will answer the question in the chat, and the question was, are there any changes with the new tax bill? I knew someone was going to ask this because I've basically done a webinar every week for the last few months, and everyone asks every time. So anything I say here is probably going to age like milk, but I'm going to make a few thoughts here, a few suggestions. But if you have been keeping up to date on this, there's the One Big Beautiful Bill is out. Part of the One Big Beautiful Bill is doing a rollback of a lot of the Inflation Reduction Act standards. So for example, 45L was originally, through the Inflation Reduction Act, extended until 2032. The current One Big Beautiful Bill is going to sunset 45L earlier. So the idea will be, there's a lot of urgency coming into these things now where you have, depending on which version you look, you have up to a year to place your building in service for 45L, which means it has to be built and has to be rented or sold. You've got about a year after this stuff, after the Big Beautiful Bill passes, to get that done. So instead of sunsetting in 2032, it's going to sunset basically in 2026. The same thing kicks in for things like investment tax credits. They're sunsetting those as opposed to going until 2032. A lot of these, like solar, as I'm sure a lot of you know, wasn't overly popular with the current administration, so they may sunset a lot of the solar credits. At the end of the day, what this really means is you're going to want to talk to somebody like Leyton. Doesn't necessarily have to be me. Your CPA can handle some of these things, but you're going to want to look at those and figure out, okay, do I need to start worrying about safe harbor rules? Because if you start construction, most of these are based on when you started construction. Safe harbor rules. In other words, did I meet substantial construction, or have I paid 5% of costs? Those are the things you need to look at to qualify for safe harbor on construction. Look at those now, because you may have to accelerate a project life cycle to be able to capture tax savings. The other thing is, it wasn't in the House bill, but it is in the Senate Finance Committee bill. They were going to accelerate the sunsetting of 179D. So 179D was made permanent in 2020. It was not in the House bill to have that sunset, but the Senate Finance Committee put it in kind of, frankly, out of the blue. Nobody really saw that coming. I don't know if it's going to make it through. 179D has been a very popular program. It's been around since 2006, so I'm not sure what will happen with that. But if they did, we're basically looking at about a 2-year window in which you want to really start construction on your building to make sure you can capture these incentives. So they can't roll them back immediately. They're all based on start of construction, so you got a little bit of time to work with it. But just a quick frame of reference again, we could get into a very long conversation about what this all means, but the overall conclusion for most of you is talk to an expert, start looking at safe harbor. Like, when do I need to start construction on these projects? So hopefully that answered the question in the chat. I'm going to make a quick pivot here, and then Seth is going to go through IncentiFind here in a little bit. But property tax, that is the other one. Kind of a tax incentive, not really a federal tax incentive, so a slightly different angle to consider here. But you should be looking at property tax, and there's a few reasons why you should look at it. But so basically, everyone should know property taxes are basically levied on the assessed value of real and personal property. It's pretty important because if you remember before, we started talking about cost segregation studies, and there's an asset classification for personal property. So cost segregation comes into play here a little bit. But what you want to do is you are allocated a certain amount of property tax. If you come into any of these situations, you probably want to talk to an expert who's going to help you negotiate relief on your property tax. So if you get a property tax assessment and you say, well, that doesn't seem right, there may be a chance they assessed it incorrectly. If you're doing just equipment transactions, expansions, acquisitions, you're probably going to want to look at the amount of property tax that you're actually paying, because there are a lot of techniques in terms of how they assess these. If you're across multiple tax jurisdictions, whoever's assessing your property tax may not know that, and that does factor in. If you've got a lot of tangible fixed assets, and your CPA should be able to tell you if they do, you might get lucky and your CPA may do property tax as well, and they might already be on this, but you want to look at it. The other big one for us is critical filing deadlines. The deal with property tax is you get a certain amount of time to protest it, and if you don't, it's done. Like, you basically agreed to it if you don't protest. So there are very critical timelines with any property tax relief or any assessment that you want done. So again, if you see anything a little suspicious in your property tax, I would immediately reach out to a company like Leyton, who can help you address some of those. Really make sure you're not overpaying taxes more than anything. So there's a few things to consider. Like we said before, there is commercial property tax. So that is a tax on businesses. That's probably what most of you are going to be hit with. So it's based on things like market conditions, which is very important. How they assess based on market conditions is really going to matter in terms of what you're assessed at. So you want to make sure that the study they did is correct, and we can help you evaluate that to make sure it is correct. That's where things like cost segregation study come into play, because we know how much is actually in the building, how much it costs. So we can really help with cost breakdowns. The other one is personal property tax. So that is basically, the equipment, computer, monitors, all these other things that are attached to your building that are not part of the building effectively. So we want to make sure those are assessed correctly. It's very important. So at a high level, property tax, a lot easier to explain than the other tax incentives, but there are a lot of steps in behind just to make sure that all the data behind it is in fact correct. And with that, I see we had another question come in from the chat, and it's a good one of the ones I like. So, hey, why doesn't my CPA just do this? So this actually applies pretty well to property tax. Kind of depends on who your CPA is. So I guess background for me, I used to work for a very large West Coast CPA firm. And if the firm is large enough, they may have people in-house who do things like I do. A lot of CPA firms will do cost segregation. Quite common for CPA firms to do cost segregation. Some of them will do property tax. Very few of them will do the energy efficiency tax incentives, like 179D, 45L. Some do investment tax credits, depending on how complicated it is. But there's a gap between what CPAs know and what engineers know. So basically, the way I explain it is my CPA partners know the tax code. Tax code's really, really broad. You go to specialist companies like Leyton to go deep into particular topics. So CPA firms don't tend to have a lot of engineers on staff to do these things, and these are really engineering studies. So you end up in that odd intersection between CPA firms and engineering firms when you deal with some of these incentives. So that's the main reason why, if your CPA is not doing this, sometimes people come to me kind of upset, like, why didn't my CPA tell me about this? I generally wouldn't get mad at your CPA. There's just so much in the tax code, and this is a very specialized skill. So cut your CPA a little bit of a break if they forgot to bring one of these up to you, and then we'll see if we can save you some money on the tail end. So I think with that, Seth, I pretty much talked for 25 minutes straight, so I'm sure people are bored of listening to me. So you want to take it from here?
Never. Sure, absolutely. I appreciate you sharing everything. That's great information. All right, everybody. Well, again, Seth with IncentiFind, and want to let you know that there's more money out there available for you than just tax incentives. So at IncentiFind, we simplify the incentive capture from search to savings. And what that means is we provide a streamlined process to help property owners identify and capture incentives on every property. You go to the next slide, please, Mark. All right, so there's a lot more than just tax incentives out there available to you. There's rebate programs, grants, fee waivers, etc. And a lot of this information is provided by the different administrator groups, and those include federal government, state, county, city, and utility company. Now, you could go DIY this. You could go cold call utility companies, Google search, and try to see what else is out there. But you're going to spend a lot of man hours, and you're not going to have any assurances that you're seeing everything available to you. So what IncentiFind has done is we've created this streamlined process with 3 steps: search, apply, and save, to help you identify incentives and capture those incentives for your property. Search, that refers to our products. Our products help you identify the incentives by showing you what incentives are applicable to your specific property. Apply, that's our application fulfillment services, where we do the application, we manage the applications for you. All we need is a point of contact for your project team, access to the construction documents, and we'll work directly with the administrator to manage the application process. Then save, that's the fun part. That's where you get the money coming back to you to put back in the project budget. All right, next slide, please, Mark. IncentiFind, we've built the most comprehensive database of green building incentives in the United States. We cover all 50 states, and we have over 500,000 ways to save by going green. One of the problems out there is that every year about $70 billion in incentives are put out there, but over half of it's left on the table. And that's basically because people don't have time or the bandwidth to go hunt these down, to find out what all is available to them, and then go through and do the application process. So that's where IncentiFind comes in to really do the heavy lifting for you and make the process easy. Our database, we include incentives from, we call it 5 levels of government. Again, that's federal, state, county, city, and utility company. And we find all incentives applicable, not just tax incentives, not just rebates, but there's grants, there's fee waivers, bill credits, loan programs, expedited permitting, whatever we can find, whatever's put out by these entities. We bring it into our database and we make it queryable and searchable for you. We are predominantly focused on the vertical assets. So many of the incentives in our database, or majority of them, they're focused on the vertical assets. So our main categories are energy efficiency, renewables, and water conservation. Really focused on making your asset more sustainable. We do have additional programs in there, such as brownfield development or PACE lending. You will find that in our database as well. But our main focus is energy efficiency, renewable, and water conservation. And then we're applicable to both commercial and residential, new and existing assets. All right, next. I see there's a question in the, when is the best time to get IncentiFind involved? Depends. Really, in the earlier you can get us involved, the better. But I'd say for new developments, it's good to get us involved in the early design stages. So whether design development or schematic design, because what you're wanting to do is get the requirements of the incentive programs in front of your design team, so that then when they're specifying equipment that's going into the design, that it matches the requirements for the incentive. So if you really want to maximize your incentive capture on your property, get this information in your design team's hands early on. So on new construction, that's in the early design development. For renovation projects, it's essentially prior to purchasing your equipment is the best time to get us involved. Sometimes programs need pre-approval from the utility company, so getting us involved earlier so we can get that pre-approval is imperative to making sure we can capture as much as we can. All right, so what are incentives? Incentives are a way for you to, get cash back on your project. There's many different forms, as you see up here. Tax credits, we heard about those from Mark. He touched on some of the major ones, the 45L, 179D, cost segregation, the ITC. But there's others out there as well, and there's other state level programs as well that are available. IncentiFind, we can't capture these incentives for you. That's why we have partners like Leyton, but we do identify them in our database. So we will show you all the tax level incentives available for you. Rebates, these are probably the most popular things we work with. These are cashback incentives for installing qualifying equipment. There's a few different categories of those, which we'll cover here shortly. But those are the quick money back after your project's complete. Grants, it's essentially free money for installing certain specific technologies or scopes of work. Fee waivers, bill credits, those come from the administrator, either waiving fees for you, meeting some qualifications, or bill credits. Those are utility bill reductions for installing, energy saving equipment. And loan programs are also offered, and those are typically low interest or forgivable loans for doing sustainable upgrades. All right, rebate types. There's four main types of rebates. IncentiFind, we typically deal with the top two here: prescriptive rebates and custom rebates. Midstream and point of sale rebates, those are really like at the point of sale, whether at Home Depot or at your distributor. And then midstream rebates are also for distributors and contractors, really. IncentiFind, we work predominantly with the property owner. And with those, we focus predominantly on prescriptive rebates and custom. The main difference is prescriptive rebates are essentially preset amounts for qualified equipment. So in this example here, you see $500 per heat pump. So every heat pump you install in your building, you get $500 back for each one. So number of heat pumps times $500, that's your rebate. You see this a lot with lighting as well. It'll be like, hey, we'll give you $15 per LED fixture you're putting in. I've put in 200 of these fixtures. Well, that's a $3,000 rebate. So there's a lot of those out there. The other one is custom rebates. Custom rebates are more paid off on the performance changes of the building. So they're performance based. So how much are you overall reducing the energy consumption of your building? And this could cover many scopes of work. It could be lighting, it could be mechanical, it could be weatherization, all of that working together to reduce the overall load of your building. That is what you get paid on with custom rebates. Custom rebates, you say 99% of them do require pre-approval from the utility company. So it's important to get started early with them, or get a company like IncentiFind involved. So we're working with the utility company and they can review this and approve it before we get rolling. See in the chat, does a contractor take care of rebates? Sometimes they have programs they're familiar with, and they will do those on your behalf. But I'll just say their main focus isn't finding every single incentive out there available to you. That's our focus. So we built this database to maintain the largest data set of available incentives. So while the contractor may know about a few programs and go after that, they're not going to go try to find every single program available to you, and they're not focused on maximizing the amount of rebate dollars that they can save for you. So while the contractor will do some, I think it's great to work with a company like IncentiFind to make sure you're capturing all the dollars out there available to your property. All right, next slide. So what is incentivized? What are the commonly incentivized scopes of work? Here, these are the main categories. Energy efficiency, of course, is the biggest one. That's where you're going to see the biggest bang for your buck. And a lot of the scopes of work under that would be, LED lighting retrofits or installing LED bulbs, high efficiency HVAC systems, mechanical upgrades, putting in VFDs, or, refurbishing rooftop units, everything that's making your HVAC system more efficient. There's going to be incentives for that. Building automation systems, controls. Again, anything that's making your equipment work more efficiently is going to be highly incentivized. Renewables and storage, yes, there's a lot of incentives out there for solar, for geothermal, for battery storage, microgrid. There are incentives out there for those. Water conservation, we do see that more in, everyone's going to have a little bit, but there's going to be more incentivized in more drought-prone areas. So if you get out into California and Nevada and such, you're going to see more water conservation measures than you are going to see in like Houston, Texas. And then resilience and envelope, that kind of pairs in with energy efficiency. You put in a better mechanical system, HVAC system that's more efficient. It helps if you buff up your insulation, have a better roof to make sure your building's tighter and retaining a lot of that cooling factors. But those are the main ones that are being incentivized. Here is here's a program we wanted to highlight. This is from CenterPoint Energy, which is in Houston, Texas. This is a custom program. This is the 2025 Commercial Industrial Standard Offer Program. And these custom programs, like I said, they typically cover all scopes of work. They're more performance-based. So as you see on the list on the right, there are many different scopes of work that are covered underneath this program, from LED lighting to chillers to VFDs and window films, and putting in solar, and even other measures that move the needle on your building's energy consumption. So this is a great example. And also it brings up a point. Rebate programs are first come, first serve. When they have a program start and they have a program end. And once they start that program, they typically have a specified budget. And when they run out of that budget, that incentive's closed for the year. So this commercial standard offer program for the year 2025, as you can see, has a $6.6 million budget started in January. The current allocation from my meeting with them last week, June 19th, it's 5.9 million has already been allocated. So they're 89% full already. So what that tells me is to tell, our customers, hey, if you're doing any projects in Houston, get going, get it turned over to Apply Services. Let us go get, funds reserved for you, because it's probably going to be closed by the time we get to September. So that's something I always keep in mind as well. Get involved early with the utility company, whether it's with us or using someone else or doing it yourself. The earlier you get in front of the utility company, the better chance you have at being successful in capturing funds. All right, next slide, Mark. Here's a few case studies for companies that have worked with IncentiFind. And this first one right here, Baytown, Texas, that's right outside of Houston. They did take advantage of the commercial standard offer program. And as you can see there, they they installed some solar panels. Their total cost of equipment you see on the left is $2.2 million. We were able to get them a rebate of over $100,000, $105,000. That's money we were able to put back in their pocket, which covered 5% of their equipment cost, recovered with rebates. So next one. Here is a hospitality, a new hotel in Cedar Rapids, Iowa. They installed, many of their equipment was eligible from, as you can see, their equipment installed appliances, custom equipment, heat pumps, P-tax, HVAC, lighting, roof. They did a few different things. The cost of the equipment, that's the cost of the eligible equipment. Of course, that's not what the new hotel cost. But for that eligible equipment, we're able to get them $30,000 back in rebates, which is 25% of the cost of the eligible equipment. And next is a new multifamily, Salt Lake City. They had a boiler and lighting and HVAC was the equipment installed that was eligible. The total cost of equipment, $425,000. We were able to get them a check for $126,000, which was 30% of their equipment costs recovered with rebates. All right. Well, as you can see, tax incentives are great and you can get a lot of savings there, but don't forget about rebates and such as well. There's a lot more money out there to take advantage of. So make sure you're not leaving money on the table. Working with companies like Leyton and IncentiFind can help make sure you're taking, not leaving any dollars on the table.
Great. Thanks, Seth. So you got Seth's contact information up there. If you're,
I see there's,
yeah,
there's some questions as well. There's one I missed.
Yep.
You want to do that now or are you closing out? Okay.
Yeah, no, I'm just clicking through here. So any of you are quick on a QR code here, and then we'll handle questions because we've got about 15 minutes left to do questions. But with that handy dandy QR code, just to book a meeting. Seth, you've got his email address there. So questions. First one is actually for you, Seth. So I think I know the answer, but let's see what you say. So yeah. What if I don't know what incentives are available? Which actually is a question we get all the time.
Yeah, absolutely. Or which incentives are applicable to my project. So we have a lot of, with IncentiFind, we work with what I call, property owners, of course, that's easy, but also service providers. Service providers are, engineers or architects or sustainability consultants that are really familiar with this data. And so they can take our reports and dive in and figure out what incentives match the equipment. But sometimes the property owners, they don't know and they don't care to know. They don't have time to know. So how do I make this easy for them? Well, that's where our Apply Services can help. So, looking at our projects and you want to know what out here is applicable to me. I don't really know how to dive into this. Working with our Apply Services, they're happy to go in and look at the Verify reports, which is our reports, go through and identify which incentives are applicable to the scope of work. All you need to do is tell them what you're planning to do, a general scope of work for the property, and our team can go help you identify which programs are available and then go talk to your utility company to ensure you're eligible for that incentive and then move forward and capture it for you. So we can take the burden off of you, just work with our team and they'll handle all the details.
Yeah, and I will say selfishly, that's one of the reasons why we like working with IncentiFind, because it's remarkable how often I get into conversations with building owners that are saying, okay, I'm having a huge amount of trouble getting enough project financing. Every dollar matters to me, but I don't have time to go look for all of this stuff. So the reason why we've been working together for so long is I've got an easy answer to that. So go over to Seth. All you really need is, your building address and your utility provider. They'll figure out the rest for you. pretty advantageous not to have to, allocate one of your people or allocate a summer intern or whatever to just Googling incentives, which is a little rough. So I've seen a number of people do that. So I think it's definitely worth looking into. It makes it a lot easier. And along with actually another question just came in. Okay, this is a fun one. Investors. Sometimes hotels have a lot of investors, and we have seen that happen in the past. So what happens in that scenario is it's kind of what I mentioned before. Seth, this probably applies less to you, but for tax incentives, generally taxes flow through to the owner. So whoever is on, whoever owns the LLC, for instance. Most hotels tend to be partnership structures, and that means it flows through to the owner's tax return. Now, what that means is if you have too many owners, you've got a dilution of value. So if we're talking $1 million tax deduction, sounds great, and it is great. But if you have 100 owners, and then you separate that $1 million tax deduction, and then you separate it over their actual taxable rate, each owner all of a sudden is getting 1/100th of it multiplied by their tax rate of about 30%. So for a net benefit. So you get a lot of dilution of value if you have a lot of investors. Now, it's an extreme example because I can't imagine there's a lot of hotels with 100 owners, but what we do often see is someone will get into a hotel with 5 or 6 owners. Then you got to really do the math on what the benefits of these things are. So just something to be aware of. Sometimes the partnership agreement will address questions like that. But if you do have a more complicated entity structuring, I would encourage you to ask some questions there. And actually, kind of semi-following one of those, there's an example I forgot to mention before, but kind of following the theme of, we need to, every dollar counts. There's a really interesting case study within property tax where every dollar counts really comes into play. So those of you who remember COVID, hotel owners probably remember buying a lot of hand sanitizer. So what happened during COVID is property assessments were happening, and they did not consider the amount of outlay all of you had for basic safety things that were not really factored in previous years. So what ends up happening is people were assessed a much higher value than they expected, and they were actually able to leverage some of these COVID era safety things they had to do to actually get their assessments reduced. So it's kind of a niche example, but it gives you an idea of the complexity of some of these service lines. And it kind of goes back to the question of like, why doesn't my CPA do this? Or why can't my tax team internally do this? You probably don't have a specialist internally or a CPA who understands that the costs of buying all that hand sanitizer can actually affect your property tax. So we get into real niche areas real quick. So I would recommend when you come into these things that basically the way Leyton operates and companies like Leyton is we do feasibility studies for you for free. And the idea is just to sit down with you and say, okay, is there money on the table for you? And if there isn't, it's fine. Generally there is, but if there isn't, it's fine. I mean, for example, that investor question tends to actually eliminate a lot of the value. If you have 100 investors, I'm probably going to tell you, don't worry too much about tax incentives. The juice is not worth the squeeze. But we do that for you for free. The reason why we do it is we've done 10,000 studies. So quite frankly, we can do them pretty quick. But I would recommend when you get into some of these niche things, just ask the question. I mean, it doesn't cost you anything to ask. And even like what Seth is doing with the incentive search, it's incredibly cost effective compared to paying somebody to do it. So like you need to go and search thousands of databases to figure out what incentives there are. I mean, the amount of labor hours you'd have to put into that is quite ridiculous. So I would highly recommend make life easier on yourself and do something like that.
Appreciate it, Mark.
So, yeah, exactly. So it
make
comes
it
up
easy for you, as is Leyton.
Yeah, I was gonna say about once a week I get that question where someone will ask me, "Hey, I've heard about incentive XYZ. What do I do about it?" It's like, go get someone to figure it out for you, man. There's a lot of work in some of these. A lot of them are pretty specialized.
Yeah, absolutely.
I mean, honestly, that was a lot of the things that we wanted to cover today. I realized we booked this for a full hour. We get 50 minutes, but I'm also not a big fan of going long if we don't need to. So do you have any parting thoughts, Seth? Anything we didn't cover?
No, I mean, I love the strength of our partnership. I mean, helping property owners find all the dollars available to them. I mean, Leyton covers the taxes, we cover the rebates and any other types of incentives out there to give you the full solution on identifying and capturing incentives for your property. And make sure you don't leave any money on the table.
Yeah, and I guess just one quick plug on the end here. If you are worried about federal incentives, don't underplay the value of state incentives or regional, municipal, and utility incentives. We have seen a lot of people get a little fearful of what the federal government is doing, but Massachusetts is a great example. The Mass Saves program is extremely powerful. Individual cities like Chicago are really driving these incentives. So I would encourage you to reach out to try to ask, hey, if I can't do 179D anymore, what else can I do? You've got options. I know it's easy to get into doom and gloom with some of the changes, but
I know.
don't underestimate the power of all of these other programs, and agglomerating all of them into one big incentive is really going to help.
NYSERDA and New York is another one too. There's a lot of state level incentives there. And one thing I guess to say too, to that point is, yeah, the federal stuff and the tax stuff, there's a lot of flux right there, right now. But as far as utilities that we've seen, we're of course keeping our eye on it, but we haven't seen a lot of major changes at the utility level incentives. So there hasn't been major programs that have been dropping off or anything. Well, you never know what's going to happen, so we're keeping an eye on it. But so far this year, 6 months of this year, we haven't seen any major changes with the program administrators that we're working with on the utility level. So those seem to still be intact and available for everyone.
Perfect. Okay, well, I think with that, everybody, you've got a booking meeting link there. You've got Seth's email address. If you need anything, just let us know. And otherwise, I hope everyone enjoys the rest of their day.
Absolutely.
Thanks, everyone.
Have a great day. Thank you.
Bye.